If you've been wondering about all of those digital native direct-to-consumer brands, the ones that are e-commerce rock stars or are about to be, then this is the podcast episode for you. Welcome to A Seat at the Table. I'm Jane Singer, and today we're sitting down with Stanley Szeto, Executive Chairman of Hong Kong-based Leverstyle. When most people were looking to exit the apparel industry, Stanley went all in. Over the next nearly 2 decades, he continued to shape and evolve Leverstyle with a keen eye towards opportunities that many other manufacturers were overlooking. His ability to work with smaller, direct-to-consumer brands turned out to be the right capability at the right time. Leverstyle was able to be the perfect partner for many of these fast-growing brands and work with them to pioneer business models for apparel sourcing that were based on speed and flexibility. Stanley, thank you so much for joining us today.
We started on this a little bit earlier than most, so we've had a bit more experience. More than half of our sales now goes to digitally native brands and platforms.
Wow, interesting.
Yeah, so the conventional ones are just 40-odd%.
I think that that's really reflective of where we're going to be seeing things going in the future. I think certainly there's a demand at the consumer level for better quality and for more uniqueness and so forth. So I think that's really where we're seeing opportunities come in with indie brands.
Right. Yeah. And we can see that indie brands are much better at targeting a smaller niche of consumers. And we see the reason as being they're not having stores on, let's say, Queens Road Central, because if you have expensive rent to pay, you got to cater to the masses. Otherwise, if you focus on too small a niche, you'll never be able to pay the rent. Whereas for these indie brands, they just have one warehouse, right? So let's say if an indie brand pops up in the US and it caters to a very small niche of the consumer market, let's say just throw out a number, let's say 2%, that's 7 million people,
right?
That can buy a product. And if you can effectively reach these 7 million people, then it's a very viable business. And these people are probably willing to pay a premium because they don't want to buy from the gaps because you're targeting their exact needs. So then those needs are not being fulfilled by the Gaps and J. Crews, and those brands of the world. So they're willing to pay a premium.
I think that what you're saying is quite true. What we've seen through some of the research that we've done at Inside Fashion's Consumer Lab is that there are a growing number of consumers who aren't satisfied with what they're seeing at retail. And yes, they will pay a bit more if they can find product that they like. And I think that a lot of the problem is just that there's been a homogenization of product. Everybody sort of looks to each other and makes the same product. One of the things that we've been hearing a lot about is a direct-to-consumer model where a brand literally carries no inventory. I guess this might be the extreme situation and only produces the garment when they receive an order. We have seen that with t-shirt printing, where people will place an order, a t-shirt will be printed and shipped to them. How possible is it to bring that through into more complex products?
I think it's very possible. I mean, a t-shirt, of course, is much easier to do. But let's say even if you do a very complicated product, let's say a men's suits, it takes a few more labor hours to get that garment off. So it's all about just coordination and the trust established between the brand and the supplier. If you have materials lined up, if you know that you're going to sell even a suit, you just don't know, which fabric you're going to be using, but you've stocked, the ones that you may sell. Then it's just a matter of just picking things out and doing it quickly. And I think right now people are starting to do it. So, I mean, let's say a custom-made suit, people are now quoting a few weeks after they place an order, they just custom make it for you. We actually used to work with a very small customer that was trying this out for wedding suits. I think the world's heading that way. In China, we were sort of fulfilling some Double 11 festival last year, the Alibaba festival, and a lot of garments that were sold were not made yet. So, materials were ready, right. And then, factory capacities were booked, but garments were not made until those orders were taken. So at the end of the day, after midnight, November 11th, then they collect all the orders that have been sold through various channels, and then they tell the supplier which model to do, which fabrics, and so forth. So we're seeing this happening already. It's not something that's way out in the future.
So then the manufacturer basically, or the brand, is taking the risk on the fabric or on the raw materials because they don't know how many orders they're going to get.
Yeah, but the raw materials are, let's say, half the cost of the finished product. product. And raw materials, you can always design into it. So let's say, I mean, when using your example, let's say a black T-shirt with different prints on it, black T-shirt fabric, you will never waste it. But if you make the T-shirt with the wrong prints and with the wrong, sizes, then the thing has to be sort of sold at a huge discount. Same thing with suits, men's suit, classic navy, you have maybe gray, black. The fabrics, unless you go into like the orange and all the sharp colors, which is actually a very small part of fashion sales anyways. I mean, the most of the fabrics, you're not gonna be buying the wrong ones and then have to write it off at the end. I mean, this is actually nothing new. I mean, Zara has been doing it for decades. It makes a call on which are going to be the fabrics that they need for the season. They buy it and then they react to sales by, changing the design, changing the size specs, changing the size assortment and all that stuff as sales roll in. But the fabric's the same. So, they can react to market within just a couple of weeks in Europe, right? So they just tell the factories, make this, make that in short sleeve, make that in long sleeve. We want a pointed collar, not a rounded or wide one or whatever. So it's not all that new. Brands have to accept the fact that this kind of production, sort of the last minute in small batches, will cost a little bit more, but then they will save way more by, I wouldn't say eliminating, but just drastically reducing markdowns and discounts and write-offs, inventory write-offs they have to do. But that's a mental sort of construct that they have to sort of tackle that challenge. And a lot of brands, especially the conventional ones, who are measured based on traditional metrics like IMUs and all that kind of stuff, those people will have no chance of coming around to this new thinking.
Well, that's one of the biggest challenges is when you have a very large business with a structure that's been in place for a long time. I don't want to say it's impossible to change, but it's very difficult to change, particularly in a fast-moving industry such as the fashion business.
It takes a lot of coordination. It's not just, let's say, the sourcing people saying, we want things fast, but you actually need to, sourcing people need to coordinate with the front line people, how to coordinate. Because if you don't get the data from the front end and use that to make decisions, you have the back end very fast and you pay more, and that premium just goes to waste because you're not really leveraging off that speed. The speed is useful only if you delay purchasing till the last minute, and so that you can react to sort of retail sales numbers. If let's say you have a big company and you have different silos, one doing retail, one doing marketing, one doing sourcing, and you have a zillion different departments, getting everything coordinated is a challenge in itself. And the sourcing people are not going to just go ahead and say, I'll collapse my lead time. But then, if they don't have the power to tell the designer, hey, you got to design into these fabric, and if you got to tell the retail people to share retail sales right away and make decisions every few days, then the sourcing people, getting quicker production and paying more is going to be counterproductive for the company.
But don't we have that data available? I mean,
yeah, the data is probably all available. It's whether, people are willing to get into that data, use that data, and make last-minute decisions. And there are always trade-offs. The example I gave, the designers have to accept that, they are going to be constrained in terms of fabric choices because you have to come up with a bunch of fabrics that you're going to use at, a little bit early on because it takes longer time to prepare the fabrics. And, if the designers are saying, hey, that's not the right way to do it, everything's got to be a very dedicated fabric for that style, because that fabric is going to be slightly better for that A style, whereas for B style, you should use a different fabric, and you're not willing to sort of share fabrics in the sort of name of the designer is like the god in the company and making all these product decisions. Then you can't move forward. I mean, there are certain constraints, and you got to sort of align everybody in the company to be subject to those constraints and have the leadership to explain to them why being subject to those constraints will actually help the brand out at the end. And I don't see a lot of conventional brands having the leadership and management to have done it yet.
From what you're saying then, using that model where you're determining the fabrics in advance and you're working off fabrics that have a lot more flexibility to be repurposed depending upon how demand comes in from the consumer, then you're looking at a model where it's more driven by size customization than it is driven by, let's say, creativity in the actual design of the garment.
Well, there is some creativity involved as well. I mean, let's say using, let's say men's suits as an example. You don't know whether 2 buttons sells better, 3 buttons sells better. You don't know whether a wide lapel is selling better. You don't know. You have different fits. Are we selling better with the slim fits, or are people now going back to the broad shoulders? But it's the same fabric. So if you can come up with different designs, but then just don't bet with your money yet, and just wait till some sales data comes in, and then you sort of you make the suits quickly in the configuration that is selling. I don't think it takes away from the creative aspect of the business, but it's going to be done differently.
Right, right. Asian factories were built to handle volume at a price. How easy or difficult is it to find factories that can handle these small, complex orders with short lead times?
Well, factories, in Asia are not set up for these sort of quick response orders. Yes, but I think things are changing. For example, China has lost its position as sort of a low-cost producer for the apparel business, years, if not, even more than a decade ago. So the only way that Chinese factories can survive is by doing small unit production, doing quick turnarounds. And, so we see Chinese factories having that flexibility already. But, next up, let's say Vietnam. Vietnam has been gaining a lot of market share in making apparel. But then you're going to get new entrants like the Myanmars, the lower end stuff like Bangladesh. Everybody's moving up the value chain, and, they're learning, the ability to come up, make sort of better quality products. And one day Vietnam is going to be too expensive as well for, to doing mass manufactured products. So it's going to be sort of figuring out how to do smaller volumes of, and we're seeing that more than half of our company's production is in Vietnam.
Oh, really?
Yeah, before we had, like the minimum order quantities were always thousands of pieces, but nowadays, if we bring enough business into it and we sort of, aggregate a lot of orders, hundreds wouldn't be impossible, and we also pay better. We're going to pay better than the Gap or Walmart who orders 100,000 units, because they're going to drive every last penny out of the CM costs. Whereas we work with customers that, we're trying to capture the profitability when there's no discounting or markdowns. And we don't mind paying a little bit more to have factories be able to respond quickly and in smaller number of units. So I see it sort of evolving, Asian factories evolving to have the ability to do that. Not all of them, but you just have to look and find and work with factories that are more open-minded.
Right. I guess that's really going to be a survival strategy for a lot of these factories. What are you seeing as a typical order size for an indie brand these days?
We're seeing 3 digits, hundreds of units. To be honest, if you're below 100 units, just the design work, having a designer come up with that and come up with a sample, it already makes it sort of financially not viable. But hundreds of units, we're seeing a lot of indie brands working at those levels. And sometimes, like we have one of these larger digitally native platforms, we do the private label. They would order, let's say shirts. They order 10 different styles, and then they only order like 200-300 units each. And then after like a week of selling, then they know of those 10 styles, those 2 in particular are selling really well, and then they place like a few thousand units of each for those 2, because they have very high confidence that those will sell well. And then the other 8 styles that are not selling as well, they only bought 200-300 units, so they're not going to have that much left over. So we feel that that's sort of the way that a lot of our customers are heading towards.
Yeah, I think that makes a lot of sense. How would you compare these smaller brands' ability to weather this post-pandemic market compared with larger brands?
I'm actually cautiously optimistic. A lot of people say that these smaller brands were fueled by easy venture capital money, and ones that nowadays private equity venture capital is much more discriminating in this kind of economy. So they're not going to get that kind of crazy money, play with, marketing and suffer losses for long. These indie brands have a much more variable cost structure. They don't have retail shop rent to pay. They don't have these retail sales staff to pay. They don't have sort of a renovation depreciation to take care of. So, if business is down, they will then just shrink, their buy. And of course, their headquarters overhead, that's still, everybody's got to pay that. The cost structure that they have on the distribution side is mostly variable. People talk about, shipping costs are very expensive. True, but if you're not selling, you're not shipping either.
Right.
Whereas for a conventional brand, if you're not selling, hey, you're still liable to pay that rent. But indie brands don't really have that headache. And one more thing, when the economy is down, these indie brands, rely a lot on digital marketing, Facebook, Instagram, Google, that kind of stuff. Those rates probably come down a bit as well. when the economy is down. So the point I'm trying to make is indie brands' cost structures, other than their headquarters, their cost structure is quite low. And a lot of these indie brands also, because they have a very lean management structure, so they rely on partners, supply partners like ourselves, to come up with a lot of design and to provide the design support, to provide this, provide that. So they have the number of salaried staff on their payroll. They tend to be much leaner than the conventional guys.
Yeah, I think that's definitely the case in many companies. They build up a very big hierarchy that, becomes very burdensome, especially when business takes a downturn. If you look at these indie brands, a lot of them have gained popularity with consumers on the strength of their unique designs and better quality. But in a competitive market, everybody is trying to fight not just on uniqueness, but price always comes into it. And from price, oftentimes, the quality can become compromised. I mean, do you see that at some point indie brands are going to go into that same track that many mainstream brands have and compete more on price?
A lot. Whenever brands face financial pressures, the easiest thing that is to do is to drop price, boost up the volume, and think that they can prosper that way. But in more cases than not, that just creates a downward spiral. And I think we can name too many of these brands that were once seen as premium, and then they discount, and then the vicious cycle starts, because they discount, they actually have to buy, the budget to buy goes down as well, because they want to keep that initial margin. So they compromise on the quality, the fabric, all the materials and all that stuff. And then the consumer is not stupid. After a season or two, and they don't really like this stuff, they will demand an even bigger discount than before, and then the vicious cycle continues. I think that's this sort of trap is there for all brands, whether they are conventional ones or indie ones. And it's up for the management to have to pick the right business strategy for that brand. To basically be true to its DNA, so that consumers like that, appreciate that, and they keep going. And there are good examples of conventional brands that have held their ground over the years. I'm sure that there will be examples of indie brands that will not do the same. So I mean, I think it's got less to do with whether they're an indie brand or not, but more to do with just the quality of the management and whether they're running the company well, and what decisions do they make when they have the sales are not doing as well as they hoped.
I think that in our industry, people tend to think that consumers are either buying the very high-end international designer brands, or they're just buying very cheap, and that nobody will buy anything in between. But yet when we look at just about every other product category, we see many different price points and different tiers, and each one is managing to do well for themselves.
To say that, hey, our customers aren't willing to pay for it is too easy an excuse to just slide down market and just go for the cheap stuff. And if everybody goes for the cheap stuff, then how do you differentiate? And then if you can't compete in the premium segment, if you slide down over time, once your brand equity is eroded, you may not be able to compete in the mass market or even the discount segment either. But I think you look at all industries. I mean, it's always a pyramid. So the most expensive stuff is going to be smaller volume, but it doesn't mean that there's no middle of that pyramid.
We've seen several decades of brand and retail consolidation. Do you see that now shifting towards a more fragmented market with a greater number of brands that are individually held?
I see a greater number of brands because, when you have because each brand can be good at targeting one customer niche, because it has a single voice, and who is this brand trying to appeal to? But I see just like LVMH, it holds Louis Vuitton, but it holds all sorts of other luxury brands as well. Kering's the same way, Richemont. So I see that there will be more sort of conglomerates of smaller brands that let's say they have a central financing structure, and they diversify the risk, so that if you hold 10 brands, there'll be some brands that are doing better than the rest, and in terms of financial planning, it's much easier, talking to investors, and you can sort of save money on like the IT, on the HR, on the finance, these sort of overheads, the consumer doesn't see that you're sharing I mean, they can't see this. This is all down to the company management. But then you have different sort of brands operating under the same roof, targeting different consumer niches. Maybe using their own factories, maybe sharing factories and suppliers. That remains to be seen. This sort of a conglomerate of brands will make sense because it's just too expensive for each small indie brand to keep its own finance team, IT team, shipping team. Think about it. If you have a conglomerate of these brands, the FedEx rates you can negotiate will be better for everybody. Whereas if you're just one small brand, everything's going to be all the overheads are going to be more expensive.
Yeah, I mean, I think that it's an interesting model that you point out, which is the portfolio of brands that companies like LVMH and Kering have, where they are sharing generic back end, but yet they're managing the front end of each brand as individual brands. So those brands maintain their own signature.
Yeah, absolutely. I think that's critical. Once you get the front end, the design, and even the product development to all across all brands, then the individual identity gets diluted. And, within one company, you may have brands at different quality levels, and if you ask the more expensive or the higher quality brand to use the same sourcing as the lower quality one, the quality will, I mean, you'll probably get better prices for that more expensive brand, but then the quality inevitably suffers.
Right. Well, I think that to some extent, we saw that over the past few decades with the consolidation of brands. And perhaps going forward, the new group of brands that are coming up will be doing things a little bit differently.
Right. Hopefully brands, new companies have learned from the predecessors, what mistakes to avoid.
So when you're looking at indie brands compared with mainstream brands, because I know that you've had experience working with both, what would you say are the core differences that you believe contribute more to the success of indie brands?
I've noticed that indie brands, the management tend to be more open-minded. They're willing to try new things. They usually start a little smaller, so they're more willing to say, hey, these suppliers, these business partners, they may know more than we do in certain aspects. Why don't we listen to what they've got to say? I think the reason for that may be twofold. One is, these companies tend to be smaller, so they need to, listen to their bargaining power may be a little bit less to start with, and they need to be more open-minded. But secondly, a lot of these management teams, these founders, actually come from outside the industry. So they bring ideas from outside the industry. Like when you have a CEO, if he's or she is just following what everybody's been doing, how is he or she going to sort of differentiate the company and do better than the rest? When we talk to our customers, these indie brands, more often than not, the founders or the key person came from outside the industry entirely. And they are, bringing in new ideas, and they are questioning, why do the traditional guys do it that way? There must be a better way. So when we talk to these people, we're able to sort of brainstorm, try new things. As long as you keep financial risk, to a minimum, try new things. That's the only way to get ahead and to learn and to, and you stumble across new ideas. Like, one of our customers, Bonobos, was founded by Andy Dunn. He was from, I forgot whether it was consulting or banking. And he set up a sort of a showroom in his upstairs Manhattan office. And then he thought, wow, these people came in to try, and once they try things on, the return rates are much lower, and the average ticket per purchase is also much higher than when I'm just selling, online. So he then set up these what they call guide shops, around the country, and that formula seems to be, working for Bonobos. But that's how Andy came up with the idea. It was not like a well strategized thing that the guide shops are going to be giving us a much better profit margin, and therefore you plan that idea from day one. It's not. It's actually he stumbled upon it and then says, "Wow, this actually works quite well. Let's try it." So and I can repeat that kind of example for quite a lot of our customers. They actually sort of stumble upon that right business model, that that new operational thinking, and then they try it and it works, and then they scale it. So I think these entrepreneurs, they are flexible, they're open-minded, and we're seeing that in the startups, the indie brands, these digitally native brands and platforms, and we're seeing much less of that in conventional brands. Having said that, we've also come across clients, conventional brand clients whose management is very progressive and they are willing to try new things as well. And I think those are the conventional brands that are doing sort of a better than the struggling conventional brands.
I mean, I think nowadays everybody has to be willing to try new things and be able to come in a way that's inexpensive, give it a try, and if it works, you can then keep improving it and put more money into it.
Sort of what the Google calls like rapid prototyping. So basically, you come up with what's the minimal viable product. Just let it run. See, minimal financial investment. Let it and see if it goes somewhere. You just keep investing in it and you keep improving it. Whereas at convention, fashion, everything's you want to do this. Let's come up with a very elaborate business plan and let's put a lot of money behind it. But by the time you've planned it all, it's you're already 6-12 months sort of behind the market. Then even if you roll it out, it won't be successful because it's behind the times. But most traditional these brands are still thinking the traditional way. They have these sort of we have these myths in the industry that these are golden rules that have to work that way. And a lot of people who've been doing this same thing for 20-30 years, they can't. They can't sort of jump out of the box and say, this whatever conventional wisdom may not be actually true in today's age. And I think that's sort of a questioning, sort of a challenging conventional wisdom. This mindset is much less apparent in traditional, the conventional brands.
The last time we spoke, you said that your company was looking at several acquisitions. Can you tell me a little bit more about that?
Yeah, we went public on the Hong Kong Stock Exchange last November.
Congratulations.
And thank you. And we felt that we have a unique business model serving, indie brands. More than half our sales now goes to digitally native brands and platforms. And we also have a strong position with premium brands. And then we have an asset-light model, which makes us a lot more versatile and agile than other factories. And so we went public with the goal of raising capital to finance acquisitions and basically mold these target companies into sort of our business model. And we just announced our first deal, and we took over a sweater company last Friday. And we just announced it on the stock exchange. And we're going to be, thank you. And then we're going to be developing that sweater capacity offshore, trying to figure out how to do small volume, quick response, high quality production. We will hopefully work with a lot of our existing customers, and because most of them buy sweaters as well. If we know them well and we can provide a product that is quick, reasonably priced at the high quality that we're known for, I hope that our customers will consider buying sweaters from us as well. And we're trying to expand our product range this way. And we're still talking to other potential acquisitions. Of course, the pandemic's been very difficult for the industry, but it's actually make our acquisition spree a little bit easier. Valuations have become more modest. Terms are becoming more reasonable. So, even before our IPO last year, we were talking to several companies, but we couldn't come to agreement on terms and valuation. And all of a sudden nowadays, these few months, we're seeing these owners becoming a lot more reasonable and realistic, so that we've gotten our first deal done and we're hoping for more to come.
You're looking at this from the point of view that by owning the factory, you will be able to drive that capability to do smaller orders and to be able to be more agile.
Well, in the past, we have owned factories, we have worked with partner factories, and we believe that as long as you have the orders coming in and you have good transparency, whether you have equity ownership of that factory or not, does not make a difference at the end of the day. Of course, you got to fulfill all the compliance. We're transparent with our customers and our business partners. But we have an asset-light business model, so we do not want to own a lot of brick and mortar factories with land, machines, headcounts. We feel that we can be much more versatile when we partner with people who already have those assets. And it's worked well for us. If not, we wouldn't be growing the last few years, and we successfully went public. And we intend to keep the same business model going forward.
So then if you're asset light, what would be the strategy of actually buying a factory?
We haven't bought any factories. We've bought suppliers, but if those suppliers come with the factories, we're negotiating to have those factories be spun off immediately so that they're off our balance sheet. And then we're also talking to companies that are already working with third-party partners rather than owning the factories themselves. So we don't intend to put factories into our listed entity.
So what's the business model for the sweater company that you just acquired?
It's a sweater supplier that works with a handful of high quality sweater factories, but we don't own those sweater factories. So we call ourselves a supplier or a manufacturing partner, but we don't want to own factories. And we feel that we're able to serve our customers better this way because we can be more versatile, and we can, in the meantime, we can also provide them with all the compliance, transparency. If we're more expensive, our customers wouldn't use us. So, we are able to offer competitive pricing and all the quality and services that Leverstyle is known for.
What would prevent your customer from going directly to that supplier? In other words, what value would you be adding to that chain?
Well, in the apparel or fashion business, the highest value add is the way downstream, where there's the branding, there is the merchandising, coming up with the product line and all that. And that's why, the LVMHs of the world are worth so much money. Next up in the supply chain, the value add is actually coming up with the design. When you talk about design, it's not just fashion design, it's also technical design. How do you come up with all the specs to make, let's say a designer, we have, customers, their designer wants to have, this blouse or whatever, but how are you going to make sure it drapes well and it fits well, and so that the design actually comes to life and it looks three-dimensional and it looks dynamic, rather than you can have similar specs, but you produce that garment, it looks flat and boxy. That kind of technical know-how, there's a lot of technical know-how required in the technical design and also servicing and understanding what our customers need. And at the factory level, when the actual cutting and sewing and linking, that's actually relatively low value added. And we feel that there are people who can do that part better than we can ourselves. So it's more sort of a cost efficient for us to partner with those people who can do that part better than ourselves, more cost effectively than ourselves. And then we focus on the high value added part, which is the understanding what our customers need, how to drive our factory partners to be able to produce things in smaller volumes and sort of high mix, low volume in quick lead times, how to come up with a technical know-how. And when we want to operate in all these different countries, we're in Vietnam is now our biggest production base. We're in China, we're in Indonesia, we're in Cambodia, we just started in India. And we may be starting in other countries as well. If you're a single company, it's hard to understand all the labor rules of all these different countries and have the cultural sensitivity to manage these, thousands and tens of thousands of workers and motivate them to do their best. And we feel that having locals do that is better. But these locals may not have the sophistication to understand what a premium designer is looking for. They may not have that ability to find the right sources of fabrics. They may not have the technical know-how to sort of express that in the most, in a garment that's most dynamic and not boxy, let's say. So we believe that this kind of partnership is better for us, better for our suppliers, and most importantly, better for our customers. If this way of working is not better for our customers, we wouldn't be in business. And so I think the numbers will prove that it's working for us.
So by working with you, your customers are able to focus solely on the creative side of the business, which is the design and the marketing. And then your company takes over from there with the technical and the compliance and managing the factories, everything else.
Absolutely. And we have the economy of scale to do that. Well, I mean, a lot of the indie brands are much smaller. Imagine you need a technician for, let's say, blouses. You need a technician for jackets. You need a technician for dresses. I mean, when the volume of that single brand is not that big, your technicians, you need that know-how, but to keep them fully employed, you're probably wasting the time quite a bit. But the way we do it, we have a basket of a big range of customers that do that product, that blouse, that dress, that shirt, that jacket. Our technicians are much easier to accumulate the experience needed to stay at the forefront of retaining that expertise. And we can do that for our customers at a fraction of their cost. So it makes sense for our customers not to bring on that overhead. You rely on us, which is a more of a variable cost structure. They pay a little bit for it, but at the end, it's going to be much less than if they were to employ that team, have that team serve that single brand. And they focus on branding, on marketing, on understanding where the consumer is heading. We feel that that's a much more productive and profitable partnership for both sides.
It will definitely be interesting to see what happens when we get past this pandemic and things return to what most people refer to as normal times.
Right, right. And, it'll be quite exciting, I think. Right now, of course, business is down for everybody. We're not exempt. But there will be a rebound. It's a question of when, not if. I mean, people are still not running around the streets naked, right? So, I mean,
Right.
people still want to feel good about themselves and and express their individuality. I mean, sure, people may work from home a little bit more, but still, I mean, people want that social interaction. They still need to head out. I mean, people who have been at home all this time and they're just so bored and, they need to get out. We're social animals. So people will want to buy clothes. But when will this rebound take place? Nobody knows. It could be 2 quarters. It could be 2 years. It could be even longer than that. But for those that have the financial power to survive this downturn, and for those whose business models are more variable and it's easier for them to survive, when the rebound happens, these people will be there to capture the benefits, and they'll have taken market share from all these dinosaurs that are falling away by the wayside and they're going out of business. Because somebody's got to clothe, the world. Aside from this pandemic, you're still going to have sort of a low single-digit growth on a global basis in terms of apparel needs, and we see that continuing, with sort of underdeveloped countries, slowly developing, in Africa and India, China, and the market's going to be there. So who's going to survive? Who's going to have the right cost structure to survive this downturn? And who's versatile and flexible enough to shrink when they have to, but also to expand quickly when the market suddenly comes back. So I think those people will win out. And we're operating on the supply chain side, and we're trying to be that. We're trying to minimize our cost structure. Everything's variable cost. We're trying to trying to take up market share.
I think it's really been interesting to hear about your business model because it defines the vision of the future in terms of a company that's flexible, but also is able to provide a certain amount of stability as well.
Yeah, this, I mean, you can be flexible, but you're not going to be the cheapest because, there's a price to pay for being flexible. And I guess way back when, like 10, 15 years ago, everybody was sort of saying, hey, we got to produce at the lowest cost. And we decided not to go down that route. We figured out that, we want to be as flexible as we can because we realized that we didn't have a crystal ball. If we had a crystal ball, we know exactly which country is going to be best, where volume sizes are going to be staying constant and this and that. Yeah, I mean, we may have a different strategy, maybe an asset-heavy strategy. But I still remember in 2005 or so, when China was about to go off quota, I was publicly giving speeches in these conferences that, hey, China's going to double its market share, apparel market share in the U.S. from at that time around 40% to, let's say, 80%. Bicycles, other sort of light consumer products like toys, light bulbs, these sort of things were all manufactured in China, and China's market share in these industries were way above 80%, to as high as like 95%. And I was publicly giving speeches that China is heading the same way in apparel, and I was fully convinced myself. And we started building a big campus. At that time we were thinking, Nike's famous for its campus, and it's like it's got greens, it's got everything. And you put 10,000 people under one roof, in a sort of like almost like a college campus, and we started embarking on that journey. And then a few years down the road, we hit the global financial crisis. China was off quota, but its market share barely budged because its costs were just rising so quickly. But it turned out that we were all wrong. We didn't foresee the costs rising so quickly. So at that time, we made a pivot and we said we want to adopt an asset-light strategy so that we don't have to foresee things, 3, 5, 10 years down the road. We just, and so that whatever the world, brings to us, we will then pivot and we can change easily. Right now, Vietnam is doing very well and, taking up market share and it accounts for more than half our company's production. But what happens if, let's say Donald Trump suddenly says, hey, I'm unhappy with Vietnam's the trade deficit with Vietnam, and we're going to slap taxes on it. Or worse, he doesn't like some politician and says, hey, I just want to embargo this country. These things are hopefully unlikely, but not inconceivable. And if we were to sink, millions and millions of dollars and, have thousands of headcounts in these countries, and suddenly these, trade considerations change, or the cost just becomes suddenly prohibitive, you can't really move. And we see these manufacturing dinosaurs get stuck with their manufacturing facilities, and they can't move quickly. And we feel that it's much better for us to be versatile. We work with partners, we establish these relationships. But if we really need to get out, it's easier than if we were to own everything ourselves.
Well, that's just it. I think in every industry, in every business, flexibility has become a core survival strategy.
The world's sort of pace of change is picking up, so that delta is. It's before 10 years, things were pretty stable, and then things slowly change. But nowadays, things are changing much more quickly because the pace of change is accelerating. It's even more difficult to see 5-10 years down the road.
Oh, absolutely. Well, Stan, thank you so much for sharing your insights. You always have a future vision that I really appreciate. So thank you for taking the time to speak with me this morning.
No, you're way too kind, Jane.
Thanks again, Stan.
Thank you, Jane.
What's your biggest supply chain challenge? Please let us know in the comments section. If you enjoyed this episode of A Seat at the Table, please subscribe to our podcast, where you'll get to hear from some of the industry's leaders and innovators. And if you're looking for an easier way to keep up to date on sourcing shifts, new technology, supply chain strategies, emerging markets, and of course e-commerce, head on over to our website, insidefashionlive.net, and consider subscribing to our weekly newsletters. You'll also find all of our contact information there. Please feel free to contact us with any ideas, suggestions, or questions. That's insidefashionlive.net.